Premium's a very interesting subject at the moment in terms of what's developing. You've got positive and negative forces in terms of premium. So you've obviously got GDP-driven growth in terms of premium volume, certainly coming from emerging and developing economies without any question. And many others have commented on the emergent middle class in many economies driving premium volume, etc. There's some negative forces, if I could describe it that way, in terms of suppressing premium volume against some macroeconomic challenged mature countries, Southern Europe, UK, etc. But also the premium rate itself, and in that regard particularly interesting at the moment, new capacity coming in from some quite interesting places that's driving, in my opinion, will drive ultimately a suppression of premium volume and rate over time. I don't see a hard market anytime soon on the horizon. I think obviously I'd need to put a caveat if there was a major catastrophic event somewhere in the world. That would have obviously a significant impact, but orders of magnitude now in terms of surplus capacity that there is in the global insurance and reinsurance marketplace would mean it would have to be an unbelievable quantum of insured catastrophic loss that would come in to actually have a destabilizing effect in terms of the rating environment. I think positive and negative forces around premium, and probably the most significant at the moment is new capital coming into the property cat world. Certainly on the reinsurance side, we're seeing that, and if you looked at what's been happening in Florida over the last month or so in terms of their key renewal season, we've seen rates reducing 20–25%, even in one case 45% on a benign claims experience. So some new capital and very much driving rates. Now that's in the property cat world. How much of that will fall down the chain is obviously yet to be seen. But certainly I believe the new capital could be, maybe should be, sustainable and have an influence in terms of the rating environment softening over the midterm. I think the answer lies in both. Maybe that's a predictable answer. We need to invest in people and in technology. There's an opportunity, I think, that maybe the industry hasn't yet embraced in terms of people. There's a sophistication at the client end of the transaction, in the intermediary and in the carrier end of our world that actually is requiring some different skill sets than those that our industry has traditionally brought in, and there's a dearth of that talent coming into the industry at the moment, and I think we could do a better job in terms of attracting it. By which I mean, in part, taking advantage of people being less attracted to other parts of the financial services world, given obvious events of the last 4 or 5 years, and being more interested in our world. If we could articulate our proposition to prospective employees, I think that would be a very good thing, and I think we could do a better job as an industry in that regard. Certainly in terms of technology, a lot of talk about big data and the technology that's driving that debate. To my mind at the moment, it's very retrospective. It's looking at the past and history as an indicator of what will happen in the future, and I think that's fine insofar as it goes, but actually I think we need to be looking at technology that's much more predictive in terms of buying habit, elasticity around pricing, those types of trends that should be looking forward in terms of risk. I think some of the changes that have happened in the last 5 years have been at our own behest, and some as a consequence, in fact, of what happened then. A lot of regulation, obviously, at a European level, in the US, and for that matter, of course, in the United Kingdom and elsewhere around the world, that's come out as a reaction to the global banking crisis of 2008 and the collapse that you reference. Some of that we got caught up in. The unintended consequences of regulation in other parts of the financial services world that has been brought to bear in our world, and probably the most notable current example is FATCA and regulation in the US around trading with non-domestic capacity, which has a huge implication for the overseas insurance company, non-US insurance company and intermediary. And again, a regulation that wasn't driven at our sector, but has had huge consequences for us. So I think regulation has certainly been a major feature of the last 5 years and a direct consequence of a reaction to what happened at that time. I think anybody that says they've fully managed to protect their organisation from potential consequences of Eurozone issues is brave. We spend a lot of time and a lot of money looking at the challenges that our business has in terms of Eurozone and exposure to it, as well as that of our clients. So the types of things that we've been involved in, a more regular frequency of risk committees, risk management committees, again bringing in experts from outside of the insurance industry, but maybe more involved in capital markets and sovereign debt and those types of experiences that have been brought into our business to help us think through the issues. Certainly there's been a significant increase in client requests to understand the capital adequacy of insurers in certain parts of Europe and their balance sheets and where their assets lie around the world. So we've had a very significant increase in client requests to our market security teams to understand insurers and reinsurers' balance sheets.